In investing, there are certain frameworks that everybody talks about. These frameworks are risk profiling, asset allocation, right? Then time horizons and investment objectives. But one point to note over here is that everything is dependent on your risk profile. Now, whether this particular risk profiling works in every scenario, for me, the answer is no. Why? Because risk profiling becomes your first set of tool when you start investing. So before you begin your investments, it always sounds very fancy to hear that you should be in your risk profiling. As per your risk profiling, only you should invest, right? Now, assuming that the person has started investing, the moment he starts investing, then the first parameter that becomes for him to make any changes is the returns. Now, when the returns are high, naturally the greed takes over. When the returns go down, the fear takes over. Whether this particular thing impacts your risk profiling, the answer is yes. Because a person who was initially balanced investor with a 60-40 kind of ratio to be invested into equity and debt, suddenly after 1 year, 2 year down the line, he sees that the portfolio has been drifting towards 70-30 because of the sharp up movement in the equity indices. Now, when you approach this particular person and ask them to rebalance, the first point that comes into his mind is about that why should I? I am making good money. Let that particular ratio be as it is because till the time I am enjoying my profits, I am not bothered about anything else. Come different scenario within the next 6 months, there is a sharp fall into equity indices and the ratio gets drifted towards 55 to 45, which was originally 60-40. In this particular scenario also, the investor is often reluctant to make any changes. Why? Because when his portfolio shifted towards 70-30, there is a particular amount that has been visible into his portfolio and that becomes a benchmark for him. So he prefers to stay invested till he finds that particular figure back. In the meantime, if the markets go down, the ratio gets skewed more towards debt automatically. And then comes a situation wherein probably he might think that this is not the game for me and withdraws in panic. So, what happened in this particular scenario actually? In the first instance, when his portfolio shifted towards 70-30, the prudent task for him would have been to get it back to 60-40, right? This was not done. Eventually, it came down to 55-45. Then it came down to maybe 40 equity and 60 debt because of the fall into equity indices. The moment whatever gains that were earned are gone and the moment the amount comes down below principal, then that's where the principle of fear strikes in. So what should an investor do? Whether he should really follow risk profiling, asset allocation, or he should seriously think of overcoming his greed and fear. For me, the answer is to overcome greed and fear because, as a natural tendency of any human being, it is always anticipated and it is always seen that the investors are excited towards profits and are reluctant to book losses, which in turn leads to a different investing experience altogether. And somehow, to bring back that investing experience again, it takes time. So, prefer to capitalize and take control of your greed and fear so that your risk profile, your asset allocation, your investment objectives, and everything do not get drift away from your investments.